The Alpha Horizon. Thinking different. Acting aware.
Welcome to the latest edition of the Alpha Horizon podcast from Algebris Investments. In this episode, we will try to talk through topics that we feel might be on listeners' minds and highlight specific areas of Algebris' expertise. My name is Douglas Branson, and I'm Head of Business Development at Algebris. Now that we've started the second half of the year, we thought it an opportune time to review the first half of 2021 and to try to summarise what has been going on in what has been a very busy 6 months. We've seen risk assets continue to hit record highs, the reflation-inflation debate has been front of mind, the value-growth relationship in equities has been discussed regularly, and the US 10-year yield continued to climb before stabilising. I'm very pleased to be joined again by our investment strategist Simon Peters, who is going to try to help make sense of what's been going on in half one and offer his thoughts on what might happen in the second half of the year. Hi Simon.
Hi Doug.
So to start with, Simon, can you summarise what happened in markets between January and June?
The biggest driver in the bond market has been the climbing risk-free rate. The US 10-year bond yield ended the first half at 1.5%, up from 90 bips at the beginning of the year and the 50 bip lows in August last year. So where does that leave us? Well, currently 60% of all bonds yield less than 1%, which means almost everything yields less than inflation. Investors therefore have a problem. Where is the yield and what risks are they taking? In fact, the highest quality bonds suffer the prospect of falling prices from higher yields. Investors therefore are losing money slowly through inflation or potentially quicker through a repricing. In equity markets, the S&P is up 14% in the first half, two all-time highs, whilst Europe has climbed 15%. Now, one of the best performing sectors has been European banks, which were up 27% year to date, and that one we did expect.
Understood, thanks. And moving on to the next question, are these market moves directly related to the COVID pandemic, or do they stem from economic fundamentals? Or is it actually a combination of the two?
Let's remember that at the beginning of the year, the vaccine rollout was only really starting in Israel, the US and the UK, whilst the EU had a slower start due to supply issues. However, during Q2, we had seen the developed world roll out their first vaccine jabs to around 50% of the population. Economies have performed better than expectations despite a new wave of the pandemic. Economic lockdowns have been loosened and, perhaps importantly, fiscal packages in the US and even in Europe have been rolled out. You might say we have entered a new era of government spending that has been unequalled in recent decades, peak monetary policy combined with peak fiscal injection. We have also seen the first evidence of inflation. Commodity prices, industrial metals and oil prices have been rising, and we've seen producer price inflation at 4 to 5%. But so far this hasn't translated into CPI or wages yet. As a result of all this, bond yields continued to climb in H1, but have recently stabilised and partially pulled back.
So at the start of the year, we obviously had a view on what investors could expect from risk assets and how economies might react and develop during the first 6 months of the year. Were we right? And importantly, were we wrong? And if so, can you outline what we missed?
We did expect a tough time in general for the bond market, but with the more junior parts of the financial credit market able to absorb higher yields via their excess spread. We also expected a reasonably decent performance in the stock market from a successful vaccination program and a reopening of economies. We were particularly suggesting that investors should reconsider bank equity. We did get the direction right in all our views, but there were a number of differences. The bond market had its worst Q1 performance in 40 years. Given most investors had been relieved to perform so well in 2020 considering the pandemic, the Q1 fixed income performance came as a bit of a shock. Quality and duration performed particularly poorly despite the improved credit environment. Bond investors have started to come to realise that there is essentially a combination of no to little return, but a fair amount of risk nonetheless in the fixed income markets. The bond market has been extending duration over the last number of years, which hasn't helped the market setup. The vaccine rollout took longer than we expected in Europe, but is now catching up fast, and the economic data has come in stronger than we expected despite this delay. This convinces us that it's still a correct strategy for investors to look at the more junior areas of the capital structure, such as subordinated financial debt and even the equities of financial companies. that are positively exposed to the start of the new economic cycle, falling provisions, earnings revisions, and likely growth for the next 5 to 7 years.
Great, thanks, Simon. An obvious highlight in the first 6 months of the year is the performance of financial equities, which, following an excellent last quarter in 2020, have had a strong half one this year. Is this sustainable in the second half of the year? And I guess, is it sustainable beyond that?
Interestingly, the recent performance of the European Bank Index and the backup of bond yields has sparked a lot more client interest in financial equities as one of the solutions as to where future performance can come from. Perhaps let's start from where we are. Despite the recent rally, European banks, for example, are only at the same level as they were in March 2009. So despite the peaks in overall stock markets, the banks are close to their GFC lows. Having come out of this current recession with 3 times the capital ratios of the GFC, the start of a new earnings cycle, dividend yields of around 7%, and a sustainability for over the next economic cycle of perhaps 5 years plus. So for me, as the opportunities in the rest of the market have been reduced either by central bank bond buying, reducing yields to sub 1%, or peak S&P leading to reduced future performance, investors need to contemplate new and different opportunities as those over the last 5 to 10 years have largely played out. Now, one such idiosyncratic opportunity is financial equities that benefit from a low starting position and a new economic cycle.
And what are the main risks that investors should be cognizant of as we head into half two?
An increase in market volatility looks assured, with a foretaste of that coming in June as markets try to grapple with the beginning of the wind down of peak monetary policy, especially as it coincides with the largest fiscal expansion that the world has seen in many decades. Central bank buying has been the one consistent policy, such that now most assets are correlated, as we've seen in 2013, 18 and 20. Of course, one big assumption is that inflation is under control. And although we don't expect an out-of-control situation, there is still likely to be some sizable shocks if inflation just marginally comes above target for more than a few months. Could the market be just marginally wrong on inflation? Well, we're seeing higher taxes for corporates in the top 1%. We're seeing higher government spending, which is already proving tricky to wind back in the US and in Europe. Supply bottlenecks, onshoring as well as incrementally more green energy spending are visibly leading to higher prices as well. Now, how the market reacts to these is probably more of a risk than the likely incremental expectation changes in the economy and COVID, which seem to be continuing on reduced volatility paths.
And then just moving to the last question, Simon, what do you expect from the bond markets for the rest of this year?
With bond yields having paused and marginally pulled back in June, we can expect the bond market to remain in a holding pattern over the summer. However, I would expect that markets will increasingly take a view regarding the recovery, vaccine rollout success, fiscal stimulus, and the very gradual withdrawal of monetary support. Combining these factors are most likely to result in bond yields heading higher and seeing continued poor returns in the quality and long duration end of the market. Those areas that we see short call dates, high back-end spreads and decent yields, such as the subordinated areas of financial credit, are likely to experience less volatility and see some decent carry in H2. We also like convertibles, some recovery and reopening trades, subordinated financial credit as mentioned, and some EM hard currency debt as well. But we do expect an increase in volatility as well.
That just leaves me to thank Simon for his time and, as always, to thank our listeners. This podcast from Algebris Investments is intended to communicate our thoughts and views on markets and also to highlight certain topics that we are passionate about. We hope that it is informative and useful, and in terms of this specific episode, look forward to assessing whether or not our views for the second half of this year come to fruition. Thanks again for listening, and until next time.
The Alpha Horizon. Thinking different, acting aware.